Why is relying on the stock market for retirement income a really bad idea?
You see, it's because of this pesky little thing called volatility. And in our industry, the retirement income planning industry, it's called sequence of returns risk. And if you've never heard of that, you better keep watching so you figure out what this means, because it's really, really important.
People think that, hey, if the stock market averages 8 or 10% per year, that means I should be able to withdraw 8 or 10% from my portfolio every year.
Unfortunately, it doesn't work that way. Markets don't just continuously go up at 8%. They go up and they go down. They go up and they go down pretty drastically. And sometimes our bad market crashes, you can lose as much as 40 or 50% of your value. Consider the raging bull market of the 1990s. There were only 2 down years, a negative 6.5 and a negative 1.5. And during that 10-year period, the market, the S&P 500, averaged 17.44% rate of return. But we all know how quickly that can turn on a dime. Let's check out a quick example. So we have our retiree here, Jane, who retires at the end of 1999 with a $500,000 portfolio balance invested in S&P 500. Now, Jane's going to take $30,000 of income per year, but unfortunately, during her first year of retirement, the dot-com bubble pops. And so we have 3 down years in a row, negative 10, negative 13, negative 23, and just 3 years into retirement, Jane's account balance is cut in half, from $500,000 down to $238,000. Now, the market does start to recover there, but then what happens? 2008, we have another huge down year, and in just 8 years, Jane's retirement account balance has gone from $500,000 down to just $100,000. Now, we have a nice recovery coming out of the crash, but unfortunately for Jane, she did not have enough money left in the account to take full advantage of the recovery, and she is out of money in just 13 years. What kind of retirement is that? So that's volatility for you. Again, that's called sequence of returns risk, and you just saw it in action. You cannot outsmart or outinvest the sequence of returns risk. The best thing that you can do is to hold a non-correlated asset class in your portfolio to serve as a volatility buffer so you can weather the storms during the bear markets. I recommend funding cash value life insurance or using a fixed indexed annuity, not as your entire portfolio, but to help you weather the storms during the down years of the stock market. Now, if you found this kind of educational content enlightening and helpful, follow my channel, share this content out there, and click the link above for more educational resources. Thanks for tuning in, and we'll talk to you soon. All right.